afternoon. Thank you for joining us today to discuss Surge Energy's Q4 and year-end 2021 results and updated reserve report. Surge trades on the Toronto Stock Exchange under the ticker SGY. Surge has had quite a busy 2021 with 2 acquisitions providing a new core area in southeast Saskatchewan, in addition to well-priced disposition of mature assets, debt restructuring, and a successful flow-through financing. With us today is Paul Colborne, President and CEO, and CFO Jared Ducs. If you have any questions, please enter them in the question box or email me at jessica@adcap.ca. As always, the presentation may contain forward-looking statements. Paul and Jared, I'll turn it over to you to provide a synopsis of 2021 and your outlook for 22.
Thanks, Jess, and thanks for everybody to patch in and sign in and hear this presentation. It's a short one. It's about 14 minutes. I've done this 4 times for the most successful oil companies in Canada: StarTech Energy, Crescent Point, Starpoint Energy Trust, and now Surge. And I'm just a lawyer. And what I've learned is, it's going to sound trite, high quality, big oil in place, low risk, conventional oil assets while they outperform deep, expensive, tight reservoirs that don't water flood and have steep declines and are high cost. It's that simple. And the elite conventional reservoirs deliver massive free cash flow, especially in price scenarios like we're living.
So Surge was out, as Jessica mentioned last night, with our Q4 year-end 2021 results, as well as our 2021 reserve report. Very pleased to be announcing what we believe to be some of the best finding and development costs in the wider Canadian oily peer group. Finding and development costs per barrel of $9.63, including our change in development costs. When you compare that against an operating netback for 2021 of over $36 a barrel, what you create there is a recycle ratio of 3.3 times, meaning for every dollar that we put into the ground with the finding and development costs, you pull out over $3. So some of the best in the peer group that we're aware of. Concurrently, finding, development, and acquisition, or FD&A costs, very attractive in our view at just over $15 a barrel, driving a recycle ratio on that same netback of 2.3 times. So very pleased to put that out into the market. Equally or even more excitingly, when we look at the long-term value of Surge, we really as management steer towards net asset value as it takes into account the long life of Surge's reserve base that we'll talk about in a moment. So on a very conservative Sproul independent price deck, Sproul being our external auditors for reserve purposes, they have said that Surge's proved plus probable reserves are worth $1.7 billion, and our net asset value after removing the debt is $1.4 billion. That drives a NAV per share of just about $17 per share on that conservative Sproul price deck that I referenced. We've also provided in our presentation on the website and here some sensitivities as we acknowledge that the price for crude oil has changed drastically since year end. So if we look at just an $80 flat sensitivity, as you can see on the right here, that proved plus probable net asset value per share jumps to over $24 per share. We've also removed any value here for our land and seismic. We have a huge land base on our unbooked locations. We only book about 456 locations in that net asset value. We have over 950 identified internal locations. So less than half of our locations are inside of that net asset value, and we haven't ascribed any value to the land. In order to realize this net asset value, Surge has some of the better tax pools that I'm aware of in the peer group, with over $1.3 billion of tax pools available to us to provide a long multi-year tax horizon to shelter these great cash flows we're going to touch on later.
2 ways to value a company Jared touched on. One is the value of the reserves and production and net present valued by the engineering firm. So that's one way. The other way is cash flow and free cash flow yield. And here's 2 independent pieces that have just come out recently. One from Peters and Company, one from 9 Point Partners, which is a big Canadian mutual fund that specializes in energy, and it highlights that Surge has the best free cash flow yield in Canada. We agree. A number of the biggest brokerage houses in the world were already calling for crude to go to $120 before Russia invaded the Ukraine. We think that's just brought it forward. The price change brought it forward by a few months. Bottom line is you have a massive worldwide shortage of oil caused by 7 years of chronic underinvestment. It's that simple. Inventories are at all-time low levels, and demand is now back to it's above pre-COVID levels, looking to probably exit this year at 102 or 3 million barrels a day. This is just further verification of that. You've got, incredibly high prices for oil, plus differentials are at historic lows. That's just a sign of the tight market. It kind of validates the point about the tightness of the market. Where do you hang out? You guys probably know this and make good returns when there's inflationary times. Oil is probably one of the best places to be historically when that happens.
As you would have seen in our release yesterday, we reconfirmed our 2022 guidance. Excitingly, at $85 WTI, Surge generates nearly $300 million in cash flow. It takes us, because of the asset base we'll walk you through, only about $125 million of total corporate capital to maintain our production levels of 21,500 barrels a day. So that means the output there is over $170 million of free cash flow. That's over $2 a share of free cash flow for Surge and its shareholders at just 85 WTI. Through many actions that we'll touch on here that were taken in 2021 to reposition Surge for the new world, where Canadian chartered banks are providing less capital to the energy space, we now have an exit 2022 debt to cash flow or leverage ratio projected at only 0.5 times debt to cash flow. So one of the lower debt to cash flows in our Canadian peer group. So what can you expect from Surge? As released yesterday, Surge Management Board continue to be focused on returning to our shareholder returns focused model. We want to continue in the very short term here to continue to reduce that debt and add liquidity to Surge and also increase our net asset value per share. Every dollar that we put against debt will increase our net asset value per share, as you saw in that calculation earlier. We'll do that for a few more months. And before the mid-year point, we anticipate returning capital to our shareholders in the form of reinstituting our monthly base dividend. Surge will be looking to provide a meaningful yield to its shareholders, something in excess of what some of the peers are doing in the 2 to 3% yield environment, subject to our board of directors approval. We're also going to continue to look at other ways to provide that free cash flow back into the hands of our shareholders over the course of the back half of 2022. Surge will be evaluating re-adding a growth wedge to our model, somewhere in the 2, 3, up to 5% growth in production per share. We'll also be looking at the potential for opportunistic share buybacks, as well as evaluating the efficacy of special or variable dividends. The $170 million of free cash flow forecast for this year at $85 oils truly is the prize, and we'll be allocating that back to our shareholders in as efficient a manner as possible over the coming months.
I mentioned to you at the outset that I was kind of bragging about our asset quality and our asset base, so I better be able to back that up. This slide just shows you from a business person. I'm just a lawyer, and I've learned, shocker, good reservoirs, high quality conventional reservoirs, wildly outperform deep, expensive, tight reservoirs. This just shows you that this in a graphical manner. Permeability along the bottom, 0.1 millit RC tighter rock, steep declines, high cost, and does not water flood. Well, I don't want to own those. I want to own conventional, low risk reservoirs that have shallow declines, low cost, and water flood like a dream. That leads you to higher rates of return, higher profit to investment ratios, PIRs, and that's what Surge has. I think the highest quality asset base in the group, and that's what drives that free cash flow yield. This is one I stole years ago from Mark. It's a great chart, and it illustrates for business people, not necessarily technical people. We have 2.6 billion barrels of oil in place in Surge net. We own it under the ground. When I came in to run Surge, they were 300 million barrels of original oil in place, and they had about 9,000 barrels a day and a 50% decline. We now have 2.6 billion barrels in place. We're 21,000 barrels a day over that. And we've only cummed in those reservoirs 6.5% recovery to date. And we book with Sproul in the net asset value calculations you saw on 9.6. So a 1% change on 2.6 billion barrels is 26 million barrels, easily $40, $45, $50 net back. On a $40 net back, that's $1 billion of value creation on a 1% change to the recovery factor. A lot of our reservoirs are going to get 20, 25% recovery factor under water flood. This has been independently evaluated. These two plays, Surge is 70% of our current company and 85% of our capital are going into two of the top 4 plays in Canada. The right-hand ranking, we agree with this, by the way, is Raymond James Research on January 25. Surge has got 70% of its company is in two of the top 4 oil plays in Canada, Clearwater, Southeast Sask, Charlie Lake, and our Sparky. And when you see the bottom line of it, why have we had such good results in our net asset value, the finding costs Jared mentioned? It's because of our high asset quality. Here's one of the plays. We think this is the one or two. The slide I showed you earlier, or Jared pointed to, does not include waterflood. When you include our Sparky waterflood, I think you'll see we think it's the best play in the country. There's Edmonton right there, Calgary straight south on Highway 2. So southeasterly of Edmonton. This play's been around since 1922, 11 billion barrel trend. I thought it was all heavy. We learned about 7 years ago that there's 4 billion of the 11 is in the medium and light gravity window of the Sparky. This play was developed with vertical wells, but no one brought modern technology to it until we did. So over the last 7 years, we've now captured 800 million barrels of the 4 billion. The dominant position in the 4 billion that's in the medium and light window. We drilled 190 good wells in a row. We're just bringing on another 18 wells this Q1. And we've taken it from 1,000 barrels a day to over 9,000. Should exit the year around 10. We still have, we think we can get it to 15 to 20,000 barrels a day over the next 5 to 6 years. Still have 400 locations to drill. As I said, we drilled 190 good wells in a row, and the P10 is the P90. What that means is the wells are all good. There's very little variability in the drilling. They're all good, and it water floods like a dream. So you can see here, we've grown it amazingly. There's where it ranks on the Raymond James study, and that's just a simple payout study, which how quickly you get your money back to drill the wells, about 1.3 or 4 million, and you get your money back 100% on that in about 6 months, and then you get it back. This is, I think, $75, $80 oil. You get your money back a second time, so 100% profit in less than 2 years.
The other pillar that Paul referenced is our newly acquired core area in Southeast Saskatchewan. This is an area we've been focused on getting back into for a couple of years now here at Surge. We operated successfully here up until about 2015, sold our previous assets in this area for a nice profit. Re-entering Southeast Saskatchewan brings a couple strategic benefits to Surge. It's light oil downstream of any potential constraints in Alberta pipeline capacity. And it's a nice complement to the medium gravity oil in the Sparky with the light oil in Southeast Saskatchewan. So a real portfolio approach here at Surge. A couple of the key indicia here, one of the second best or best plays in Canada. We get our first payback, as Paul said, about $1 million to drill a well here in Southeast Saskatchewan. We get that back in about 4 months at today's pricing. You get a second return of your money or 100% profit in about 14 months. So highly economic. We've got about 5,000 barrels a day out here. We've identified over 200 net drilling locations in this area already. That means about an 8-year inventory of drilling at our current pace. So great runway out here to continue to add wells, these fabulous economics that I referenced. The net backs here, meaning our profit in the field, if you will, so revenue less your field lifting costs, is well in excess of $60 a barrel at 85 WTI. So you can imagine what that looks like at today's price of 105 or 110 US. So very excited to be back in Southeast Saskatchewan. One of the last key indicia here for us is these are new assets. They have new pipelines and very little environmental liability, which is key to Surge. As you can see on this slide, ESG, environmental, social and governance principles, very important to us here at Surge. Few key points. We published in December our inaugural ESG report, which I'd encourage you to read. It's available on our website. Very focused on a couple of things here. One is reducing the environmental footprint of our operations. We abandoned or returned to a natural state, if you will, 270 wells last year in 2021 after drilling only 48 wells. So you're abandoning 4 or 5 wells for every one new well you drill, constantly reducing the number of inactive wells in Surge's portfolio. Equally important is reducing the emissions intensity of our operations. We put capital to work in Saskatchewan particularly to conserve natural gas from oil production that was previously flared. It is now captured. So what that does is reduce our Scope 1 emissions in Saskatchewan nearly 50%, with a 95% capturing of flaring on the afflicted properties. 70% reduction in Scope 1 emissions in Southwest Saskatchewan. So that's a win-win project for Surge with the aforementioned intensity reduction, but it's also a profitable project. With today's natural gas pricing, we're able to conserve those volumes and sell them into the market.
9 of the top analysts in Canada have target prices on Surge up to $12.75 a share. I think we're trading around $8.75. When you saw the new net asset value calculations, Jared said at given a net asset value of Surge at Sproul, independently engineered, $16.94 at just $70 flat WTI pricing. We think we provide a great runway for shareholders. So you got target prices that average $10.50, some up to $12.75 this morning on our latest press release. And then you see one of the highest free cash flow yields in the country. So it's kind of thrilling for me. Our goal is to be the top performer in Canada, and we're already on our way there. And as some of our bank-induced hedges have run off here, our cash flows are starting to go up to the right very quickly. So I think this is our year to outperform the entire group, and it's starting to look like we're going to do that.
You're trading at a good discount to NAV compared to, can you give us an idea of where you are compared to your peer group?
Yeah, a lot of our peers on the 70 flat deck, which is the one on the left-hand side of this slide, which I think is quite low, and so does everybody else, but that's it. A lot of our peers are trading already at or near or through their proven plus probable value. What's exciting for me, and it does lend credence to the Sproul report and the value of our Sparky and Southeast Saskatchewan assets. Our proven plus probable $16.94 value just shows the runway, if you will, for shareholders. So I think there's lots of gas in the tank, as it were, with respect to Surge's share price valuation.
Great. That kind of leads me into, I mean, you touch on the superiority of your reservoir, and just maybe you can dive a little deeper on what makes your reservoir superior. You could just touch on the porosity, the thickness, that kind of thing, which makes it more water floodable, as well as with lower risk drilling.
All that matters is this slide. And people say to me, because I'm a lawyer, well, how have you created with different teams for the most successful oil companies? It's not me. It's asset quality. And this slide just shows. So think of Surge as having some of the highest quality reservoirs in Canada, the Shaunavon, the Sparky, Southeast Saskatchewan. These reservoirs are what worked for the majors in the 40s and 50s and 60s when oil prices were $3. That's how lucrative they are. You can imagine how good they are at $105 or $10 US a barrel where we are today. And yet everybody wants to still, it was sexy, go to the Duvernay, go to the Permian, go to the Montney. Those reservoirs along the bottom, as you said, permeability, 0.1 millit-RC and tighter rock, have proved to be massive capital destroyers on Bay Street and Wall Street, and really soured a lot of investors. Well, I don't want that risk. I want the highest quality, lowest risk, lowest cost reservoirs. And that's what leads me to this slide. And that next slide is, look at the runway we're showing. A 1% change, like we expect to take the recovery factor from 9.6 and easily up to 20. Well, that's a ridiculous amount of oil still to come out of our, it's 260 million barrels of oil still to come out of our reservoirs over what we're booked at today. It's a lot of oil, put it that way.
It's a lot of oil.
Yes, it's almost mind-boggling. It would be like almost tenfold increase to our net asset value. And there's not a lot of risk to it because these are conventional sandstones and carbonates that water flood. It's a very good question. It's pretty much all that matters in the bigger picture of why we're going to outperform peers. It's not me, it's not Jared, much as I'd like to say it is, it's the quality of our asset base.
Yeah, and you continue to see that year over year, that steady progression in increased bookings of recovery factors from about 9% to 9.6% this year over year. So as the reservoirs continue to perform over time, these long life elite reservoirs, the reserve auditors slowly over time continue to add those recovery factor barrels, as Paul noted, as you get up to those 10 to 20 to 30% recovery factors in different pools.
Yeah, so it's a pretty contiguous pool as opposed to some that are much more variable.
Exactly.
Yeah.
Exactly the point. Yeah.
Yeah. Now you plan to drill 36 Sparky wells this year. How many will be done with your new completion techniques that you've been utilizing? And do we have any more data on those wells that you've done thus far?
Yeah, great question. So I've gone to the Sparky map here, and one of the new developments here at Surge is been watching the great success with some of the open hole multi-leg drilling styles that's been done in the Clearwater play that some may be familiar with, but applying that technology along the heavier window of the medium oil window here, that checkered line, dotted line, about 20-degree API, having some great initial success as we previously press released, having some wells well outperform type curve. We are going to be doing up to another 7 or 8 of those wells over the course of 2022. What we're continuing to do here at Surge is be conservative and continue to pilot two different mud systems, an oil-based system and a KCl or brine-based system. We've done 2 of each here in the first half program. So we're continuing to watch those. We'll be out to the market with more results there, but continues to be very intriguing and potentially does a few things for Surge. One of the over 425 drilling locations we have here in the Sparky, it's going to take some that are still quite economic, but they're still, say, a tier 3 as compared to a tier 1 location. We'll high grade perhaps 60 of those locations into tier 1 or 2 locations. It also opens up potential other pools and play types more along that dotted edge here, which will allow us to expand our already dominant position here in the medium and light window of the Sparky.
So we could expect to hear more about that in your Q1?
I think in the coming months, you will continue to see us provide additional updates to the market on the exciting developments with that multi-leg tool. That's another great tool in our toolkit to complement the horizontal multi-frac technology we've used predominantly in this pool.
Okay, that's great. Thank you. So let's move on to Southeast Saskatchewan. Obviously, fantastic acquisition you bought. And if you want to go through the metrics you paid, which were pretty phenomenal.
Yeah, so we paid $218 million for 5,000 barrels a day. And at the time, we used a $60 price deck for crude. Well, crude is obviously over 100. So we thought we were paying about 3.5 times cash flow, and we're now looking like we paid under 2 times cash flow for those assets. And as Jared touched on, they come with big oil in place, 250 million barrels of oil in place, highest netbacks in Canada, over $60 a barrel at 85 WTI, and some of the best payouts in the country, ranking second only to the Clearwater play on that payout analysis that Raymond James has done. So yeah, we're thrilled about it, highly accretive, debt adjusted. And I really, I got to just say, I would have been happy if crude stayed at 60 at 100. We stole these is how we feel. Our timing, sometimes timing goes against you. In this case, it worked wildly in our favor. Yeah.
Yeah. Now with oil well over $100, would you accelerate this area? You're saying you're going to drill about 27.5 wells this year. Would you accelerate drilling in this area? If you add that wedge growth, would it come from here? Would it come from the Sparky, half and half? Do you know yet?
Yeah, so we would probably have a balanced range to it or whatever. Like we're not going to really accelerate so much as add a growth wedge back. Right now, we're staying flat for only $125 million this year on cash flow of $300 million. So generating over $170 million of free cash flow. So if we add a meaty dividend, and Jared, I want to make clear, he said 2 or 3%. He was talking about our peers, I think. In our case, we want to add a 5 or 6% dividend yield, which is about $40 million out of the 170 of free cash flow. Then we'd look to do probably a share buyback program at the same time. So that dividend, we'd still have like 120 million of free cash flow. So we'd probably add a growth wedge in, to your point, maybe about 20 million more capital. And it would be probably balanced between Sparky and Southeast Sask, maybe even throw in a Valhalla well or two. So yeah, we've never actually had a company that had this kind of free cash flow, to be honest with you.
You don't know what to do with yourself. It's
great.
yes.
Yeah.
As opposed to people fighting over dollars. Yeah. On that note, because you will have so much free cash flow, there are, certainly other assets in the area. And overall, if you can give us an outlook actually just on M&A generally that's happening in Western Canada right now, as far as availability of assets, and then to your core areas, do you see stuff for sale that you'd be interested in buying?
Yeah, for sure. I think there's probably as much production and available assets on the market as we've ever seen right now with this ramp up in oil prices. You're seeing a few things happen generally in the market from our perspective. You're seeing a lot of private equity backed smaller players looking to get off positions they've been on for 8+ years when they expected to be on it for only a fraction of that time. And you're also seeing corporations and producers such as Surge looking to sell some non-core positions. So there's a lot out there. Surge continues to be very disciplined. When we review M&A, it is one of our core competencies here at Surge. But if you were to see us out in the market, it would be things that make sense, that increase the free cash flow, that are additive to our business model, and potentially tie into some of these core areas. With respect to Southeast Saskatchewan, there is still a lot of smaller players in here. There is potential for consolidation. We're going to continue to be quite disciplined as we review that, but there's a lot out there that could potentially be additive to Surge's free cash flow model and shareholder returns model that we're aiming for here in 2022.
And given there is so much for sale, and that some people have held on to these assets for as long as they have and have had to delay wrapping up some of these PE funds, are they being reasonable on their ask on pricing, or
when
not
crude
so much?
spikes? Yeah, when crude spikes like it has, it kind of makes buyer and seller go further apart. Buyers obviously want to buy it cheaper, and sellers are like, hey, look at the spot prices for oil is $95 a barrel US, and you're evaluating my company at 75. And in our case, we're gonna, with a 12 to 14 year drilling inventory of two of the top 4 plays in Canada, we're not going to chase anything. We're going to get a deal that makes sense, as Jared said, operationally, and on terms that make sense and are accretive for us, or we're not going to do them. And that actually makes vendors want to own your company shares in a deal more. It's so our goal would be anything that works. We want to get a really nicely accretive deal, and then they can get the value as the share price moves up. And if they don't want that, then don't sell to us, because as you rightly said, there's so many PE firms, the companies that are pretty good companies that are 7, 8, 9 years into a 3 to 5 year business plan, which a PE firm wants to turn that capital over quickly. So we think, there's tons of product, but we're sifting through to look at the best things, but we're going to be really disciplined before we do anything on them.
Okay. And given that, I mean, with everything else that's for sale, I mean, you have some non-core assets. Would you consider selling them now, or hold off until things?
Oh, we're always looking. We have several people inbound lately on our Shaunavon property. It's about 1,200-1,300 barrels, nice asset, but really good cash flow, but just not really core to Surge. Our Nevis property, I just had an inbound this morning on it. It's about 160 barrels. It's not a big deal, 180 barrels, but so things like that. Yeah, we don't have much non-core now. We're pretty focused in our 4 main areas and really in the Sparky and Southeast Sask. And
would you add another core area, given you have the drilling inventory you do?
In our situation, you pointed out actually the valuation from Sproul. I think our stock, if you take a $80 price deck's around a $20 stock, and we're trading at 8 or 9. So cost of capital wise, there it is right there. So somewhere between $15 on the 80 flat case, which I think is pretty fair right now. I think our stock's about a $15 to $20 stock. And I think investors are starting to get that. That's why our stock's starting to outperform. And I think people were waiting for this chart. So the more they see it, they'll go, oh, a lot of our Surge's peers are trading at their proven plus probable already or near it. And we're not. And we're starting to outperform. So I think we're exactly what investors are looking for, something that can show that visible, value proposition right now. So
you've got value with catalysts. It's exactly pretty compelling story. Yeah. Now, also on that topic, you mentioned in your presentation your 1.3 billion of tax pools, which gives you an excellent non-taxable horizon compared to many of your peer group. Again, where do you stand compared to your peers?
Yeah, I think amongst our peers, we believe at our size, we've got a very attractive tax horizon, multiple years here at $75, $85 oil, where we will be completely untaxable. We have seen some peers come out here recently and announce cash taxability even this year at higher pricing. So we think comparatively, we're well positioned here versus some of our peers to shelter these great free cash flows here with these 1.3 billion of pools and deliver that tax effectively to our shareholders.
Now you had your mandated hedges last year. We discussed that on the last call, and you did add hedging as a part of your risk mitigation. What does your hedge book look like for this year? And with that, your sensitivities to cash flow?
Yeah, good question. So as Paul noted, our bank mandated hedges rolled off almost 3 months ago now in December of 2021. We do have some acquired hedges that came through the acquisitions into Southeast Saskatchewan. Most of those roll off here in a matter of a few days at the end of Q1. We do have some that go on for a couple more months thereafter to mid-year. And then they really waterfall off through the back half of 2022. All the free cash flow and cash flow sensitivities that you see in the presentation here are inclusive of any hedging positions that exist. So you can see here the move from 85 to 90, we have a $20 million increase in our cash flow and free cash flow. And that's inclusive of some of those positions that have been put on. They waterfall from 50 to 40 to 20%, as you can see in a bit more detail in our corporate presentation on our website. So they come off very, very quickly.
Would you look to add more hedges, or are you just going to kind of hang in with what you have?
We're in a pretty good position here in the near term, but we're always going to continue to watch it as part of that risk management process you referenced. But as we reduce debt further and further here, thematically, there's generally less of a need to hedge more and more barrels. So you'll likely see a reduced profile hedging going forward as we reduce the debt and provide more free cash flow that we can in turn give to our shareholders.
What would be your current debt right now?
Current debt, as reported, was at year end was about $330 million.
Yeah, I know. As reported, but
and then you can continue to expect to see the net debt drop over time here. We would expect to be inside of the debt range that we put out of $250 to $265 million here inside of Q2. So in a matter of a couple of months, we'll be down into that 250 to 265 net debt range.
Thanks for not answering the question, really. But when you do add in your dividend and buyback, or if you just chose to do one or the other, but if you wanted to do both consecutively, what price would you need to see oil stabilize at?
Yeah, I think anything in these ranges here, I think Surge will be in a position here at anything north of $70, $75 oil to be looking at instituting that dividend on that, before the mid-year point. As prices increase, that can either do a few things. It can provide additional free cash for the growth that Paul referenced, as well as the buybacks. So I think you'd see us put the dividend in place and then continue to put some of the free cash towards the balance sheet and continue to drive down the debt a little bit more, and then start to look at growth wedge, buybacks, as well as the potential for variable dividends. So that's sort of the order I would think about it in.
Okay. Any comments on emission standards which federal government is bringing forward?
I don't think there's any specific comment on it other than to say we are very focused on it. As I referenced it, we're reducing our emissions intensity in Saskatchewan, particularly where there's a lot of historical flaring. So where we can make these sorts of 30, 40, 50% reductions in scope 1 emissions. We want to continue to be ahead of that, but nothing, unless there's a particular mandate that person wanted to chat about, nothing in particular that I'd reference on federal mandates.
And your current level of production is 21,500 is what you stated. Obviously, I would say with the success you had in Q1, likely maybe a little higher.
Very good question. Our current production this week was 21,300 barrels a day. We were the cold weather in very late December and the first 2 to 3 weeks of January hit us pretty hard. That's all come back on. We then had a little fire we referenced that we got on way quicker in Menard in Southeast Saskatchewan. That didn't hit us as much as I thought. We still have probably close to 2,000 barrels a day to bring on from the drilling in Q1 here. It's gone better than we anticipated. So I think we're going to peak out around 23,000 barrels a day, flushed up going into Q2. So looking very good. And we drill a Valhalla well, which is always nice. We're only 53%, but we operate, that's usually 1,000 barrel a day IP. Those wells are amazing. So I think we're in great shape on the average number for the year, but in Q1, I don't expect to be way above because a lot of that production comes on during the quarter. But Q2 looks really good. Like I think we could peak out at, 22,500, 23,000 kind of flush through the breakup quarter.
That's great. You do have some of the best leverage to oil prices and free cash flow, yet you're only trading at $90, 3.5 times free cash flow. The group's higher. How do you think what can you do to close that gap, do you think?
I think we just did it this morning. One is putting out independent research from Sproul on a $70 deck. You're showing people a $17 P plus P now. Even if you want to use 75, it's $21 and a total proved of 13. Those are amazing numbers. And I think one of the key things, have our hedges, as Jared said. I think people like yourself getting, these bank mandated hedges are over. Our cash flows go straight up to the right in Q1 and really in Q2 as those hedges have come off. So I think just doing what we're doing, getting the story out, the NAV story, and then the independent research. Like I said, there's two ways to value a company. Look at this. The top free cash flow yield in Canada, as independently reported by Peters and 9Point, two pretty savvy firms. And then you put the NAV as the other way to value the company. Both those, I think, are smart investors like yourself, your firm, and people on this call are going to go, wow, I want to own that stock. That one's going to go up. So I think we're just doing everything that we should be doing, working hard to get the story out. But the story really came out last night, and we think there's going to be a great reception here in the next, especially if oil stays anywhere above $100. I just can't believe that surge won't continue to outperform.
Yeah, no, and I think even if we do see oil kind of come down to a more reasonable level, and we get to a true supply demand picture as opposed to a war, without the war in the way, which I don't know when that will happen. I think we're still pretty comfortable around 120-ish for the balance of the year. I don't think you have much downside from here. Any criticisms you're getting on the company?
Not really. I mean, a lot of the hedges that we're on were mandated by the banks in the panic period late in 2020 when crude double crashed a second time with the Delta variant. That's proved those hedges are now gone. So I really have had no criticisms at all. We're one of the top 2 or 3 performers in the market since early December of 2021. So I think people are seeing the runway. I think people were waiting to see the net asset value last night and this morning that just came out. No, it's been exciting, and people are making money in our stock. That's always a good thing. So yeah, we're pretty pumped about it.
Oh, one question I have: will you come out with an ops update prior to the your Q1 release, or no?
No, given that Q1's likely coming in early May, look for an ops update for us in really only 6 weeks or so in our May 4th release.
Yeah, that's true. There's not much time. Okay. All right. Well, thanks, guys. I really appreciate your time. And if anyone else has questions, please email them to me, or if you'd like a meeting with the company, I'm happy to set that up for you.
Thanks, Jess.
Thanks. Okay.
Thanks,
have a great
everybody.
day.
Yeah,
thanks very much.